Hey guys, Assalamu alaikum. Welcome to my channel. On today's video, I'm going to discuss a very basic concept of accounting, which is debit and credit. And also, I'm going to show you a very easy trick to determine which particular accounts should go under your debit entry and which particular account should go under your credit entries. Now, I have seen a lot of students who are struggling to understand this basic concept because a lot of time the teachers and their peers, they actually tell them that you have to memorize this. Like, say for example, any kind of asset, it should automatically go under debit account as a opening balance. Also for liabilities or owner's equity or revenue, those goes under credits and stuff like that. Now, sometimes what I find is that it's very hard for students to memorize those type of things because it's a little bit confusing. I understand. That's why I'm actually making this video to make your life easy. Now, if you like this video, please do subscribe and also put the like button. It will really help me a lot. And as you know, everything in this channel I say is completely my personal opinion, and I'm just sharing my personal experience with you guys. And everything I say over here is completely free. At the end of the video, I'm not going to say that join my online course in order to get the actual answer. But anyhow, so let's start with it.
We start accounting with a very easy equation. The equation is A equals L plus OE. Over here, A stands for asset, L stands for liability, and OE stands for owner's equity. Now, OE or owner's equity, it actually has three components built into it, which is capital, net income, and withdrawal. So basically, capital is the amount you initially put into your business. Net income is what you generate throughout the year. And withdrawal is basically withdrawing funds from the business. Now, when we say net income, what do we mean? The net income is actually your revenue minus your expenses. So now let's put everything together. So what we get over here is A asset equals liability plus capital plus revenue minus expense and minus withdrawal. Now, from this equation, let's put everything on the let's make everything positive. All right. So what we're gonna do is we're gonna move our expenses and our withdrawal on the left because they have a negative sign over here. If we move them on the left side, it becomes positive, and then we leave our liability, our capital, and our revenue on the right side. And guys, this is the most brilliant part. When we do our T accounts, the T accounts looks like this. All you need to remember now is that left is your debit and right is your credit. So say for example, you bought a pair of shoe and it cost $500. What's gonna happen? Your cash will go down and your shoe asset is going to go up. Since shoe and cash both are part of your asset, only the left side of this equation will change. And the reason being, initially you have cash sitting as your asset. But now that you have purchased your shoe, your asset cash has decreased. And now it has transformed into a new asset, which is shoe. So basically what we do here is we are going to increase one of your asset, which is shoe in this case, and we will decrease another asset, which is cash. Now the question is, how do we show this into an accounting entry? So what we do is we increase the debit side of your new asset, which is shoe, and we also increase the credit side of your previous asset, which is cash. That way, both of these accounts cancel each other out. And as you can see, the net balance after this transaction is 0. And this is what we call double entry accounting. Alright, to summarize guys, for the left side that has your asset, expense and withdrawal, whenever these three accounts balance goes up, you have to debit them on your T account, and whenever asset, expense or withdrawal amount goes down, you have to increase the credit side of it. So in this particular example that we just shown, since both of them are part of the asset class, that's why it is showing that the shoe went up but the cash went down, because whenever you are showing that you are adding, you have to show that your debit side is increasing, and whenever you are showing that you are subtracting, your credit side will have to be increased. And when you look at the right side, it has your liability, it has your capital and your revenue. So you just reverse the order. So basically, say for example, if you want to increase your liability, basically you have to increase your credit side of the T account. And if you want to say reduce your liability, in that case you have to increase the debit side of your T account. So say for example you took a $10,000 loan from the bank. In that case, your cash has gone up because the loan has come into your bank account, and at the same time your liability as account payable has gone up. So since your cash is sitting under the asset section on the left side, so to increase it, you have to debit your cash, and at the same time, since you are increasing your liability, you have to increase the credit side of your liability account. This is the basic. So basically what happened is, whenever any of the accounts on the left side, whenever it goes up, you have to increase the debit side. And whenever this right side goes up in value, at that time you have to increase the credit side. So say for example you made a sale for $100. Then your asset, your cash, it's going to go up. So you have to debit your cash. And at the same time, your revenue goes up. So you have to increase your revenue, which is the credit. So the transaction will look like this. And as promised, along with this, let me quickly give you a quick overview of financial statement. What do you mean by that? So when we start our accounting, the first thing we do is we analyze a transaction. Now, what do you mean by that? Say, for example, you are about to open a business and you made a contract with the bank saying that, hey, I'm going to use your bank account going forward. Question is that a business transaction? The answer is no, because there wasn't any monetary value, or there wasn't any asset of transfer. It's just a contract between you and the bank. Or even better example is, say for example, you decided to open a business. Is that a transaction? No, it's not. It's just you deciding to open a business. But say for example, you decided to open a business and now you have invested $1,000 into the business. In that case, yes, it is a transaction because now there are money involved in it. So if we want to list this transaction, how are we going to do it? Let's take a look at our previous notes. So if you open a business, basically your capital is going up and your cash, it should go up. Now from this chart, take a second and try to understand which one should be debit and which one should be credit. So your cash is involved because cash is going up, and also your capital is involved. So your capital is going up. So since capital is over here on the right side, if it goes up, the credit has to go up. And on the other hand, if your cash is going up, since it's part of the asset class, your debit has to be gone up as well. So the transaction will look like this. So once we analyze the transaction we decide that, hey, yeah, you know what, we have to list this transaction in our financial statement. The first thing we do is prepare a journal entry, and this is exactly what it is, a journal entry. After we are done with our journal entry, what we do is prepare a T account, and this is the T account. Once we are done with T account, usually what happens is a business might have different type of accounts. Like a business can have cash account, they have account receivable accounts, they have accounts payable, they have owner's equity, retained earnings, and all those different T accounts. So basically what you do is, first you prepare the T accounts based on where the starting balance should be. Like say for example, if this is a cash, your starting balance will be on the debit side. If it's expense account, in that case your generally your starting balance will be on the debit side. If it's a withdrawal, it has to come on the debit side. If it's a liability, it comes on the credit side. If it's a capital, it's come to the credit side, and then revenue also comes to the credit side. Now once you have all these accounts listed, what you need to do is prepare a trial balance, and then based on your month end transactions, you have to do an adjustment entries. Now adjustment entries is basically, say for example, for your business purpose, you have bought 100 pair of shoes, and then you sold 50 of them. So at the end of the accounting period, or end of the month, basically you have to count those 50 that has already been sold out. And if you have 100 of the 100 pair of shoes in your inventory, basically you have to subtract that 50 shoes that you have already sold off, and that will be your adjusting balance. And then from there you prepare an adjusting trial balance. And once you're done with the trial balance, basically all you do is start preparing the actual financial statement. Now financial statement are 4 in total. The first one is your income statement, and the reason being, the income statement is basically shows your revenues minus your expenses, which gives you your net income. And then you use this net income to prepare a owner's equity statement. And from owner's equity statement, you have your starting balance, you have your net income, and then you have your end of the year retained earning. And you take this retained earning and then you plug it into your next financial statement, which is the balance sheet, and then you have your cash flow statements as well. So in this particular video, I'm not going to go that deep. I'm basically just giving you an overview of what to look for whenever you are studying accounting in school or university. I hope that this video was helpful. If you liked it, then please do subscribe and put the like button. It will definitely help me a lot. And if you have any comment, questions, suggestions, please do leave it at the bottom in the comment section. And hopefully I will see you in the next video. Take care. Bye.